Hey, what's up everyone? It's Kirk here at Option Alpha, and I wanted to jump on live before the end of the weekend and talk about buy the dip. It is the worst investing advice you could hear when it comes to options trading. And if you do it the way that we do it, as far as like having a balanced portfolio, you'll hear in this live stream why it's a bad idea, because actually really sets you up for more failure, honestly, because you actually start digging yourself deeper and deeper into a hole. So I want to show you with my portfolio why buy the dip is a bad idea, but I'll show you, or I'll talk about kind of this concept first because I think it's really important. But if you trade options, and this is mainly for people who trade options, well, let's even take a step back. Buy the dip is a common slang term in options or stock trading because what happens is that people assume that every dip is a buying opportunity. So you hear all the time, if the markets fall, buy the dip, right? We add into our stock position because we've got this long stock position. But as options traders, terrible idea. And here's why. If your portfolio is already neutral, which you should always be working towards a neutral portfolio anyway, right? Where you've got a good balance of bearish and bullish positions on both sides. If your portfolio is already neutral, then when the market actually moves lower, right? Your center of your portfolio is now higher than the market's new price, right? Do you guys follow me on that, right? So if your portfolio before the market dropped was totally neutral, right? You had good balance, the market was even on both sides, then when the market moves lower and shifts lower, the center of your portfolio doesn't change. The portfolio stays exactly where it is, right? Your positions stay exactly where they are. The market just moved, right? So when the market moves lower, your portfolio naturally becomes more bullish. Do you guys understand that, right? It stays higher. Now you actually need the market to move higher for you to make the most amount of money. So there's no point in adding or buying into the dip because your portfolio is actually naturally become more bullish. You need the market to recover back to where it was for you to make more money, right? If that makes sense, give me the hearts, thumbs up, etc., right? So what people often do is that when the market dips, they get into all these long positions. And what they do is they start digging themselves a deeper and deeper hole because their portfolio is already too bullish, right? Or bullish enough, right? That they don't need any more long positions, but they start adding all these bullish positions, right? Because they're buying the dip. They buy the dip. This is a buying opportunity. Buy the dip, buy the dip, buy the dip, right? But they've got enough bullish positions in their portfolio. What they need is they need more bearish positions. You need to trade the move that the market makes. So if the market goes lower and you were neutral, then you add more bearish positions on the bottom side, right? Does that make sense? Okay. So that's why you have to actually trade the move that the market's making, which is counterintuitive for people. So like when the market moves down, you should be adding more bearish positions if your portfolio is staying, like if you want it to stay neutral, right? You want to add more bearish positions so that you continue to move down with the market. You don't want to add any more bullish positions. So let me flip over to my screen here because I think that'll help out. If I kind of show you what's happening here. Now this is happening in reverse for me, just so you guys know. So it's not a buy the dip scenario, but our portfolio at the beginning of the week was pretty, was like 100% neutral. I mean, almost. It was really, really close. Let's flip over here so you guys can see. So this is our beta weighted portfolio curve. You can see it's to the S&P Y and it's beta weighted down at the bottom, right? Portfolio beta weight. So let me try to hold this as still as I possibly can here for you guys. So this is our portfolio right now, is beta weight to the S&P. And the S&P right now is moving right here, right? Now previously, beginning of the week, the S&P was right about here. So now that the market's actually moved higher, our portfolio is naturally more bearish, right? The market moves higher. We make the most amount of money if the market moves down. We make about $4,000 on the existing positions that we have for October if the market moves down about 2 points, 3 points on the S&P, right? So this is what I'm talking about. In this case, this would be like sell the rip. You talk about all the time as like sell the rip, buy the dip, whatever, whatever terminology you want to use or slang you want to use. But this idea that when the market goes higher, you want to get more bearish. No, we're already bearish. We make the most amount of money if the market's already moved lower. So what we want to do instead is start adding more bullish positions to our portfolio, or at least start skewing some of our trades a little bit more bullish so that we compensate for the fact that we've already got some bearish positions in place, right? Those are already there. They're existing. We don't need to add any more to it. We need to start becoming more and more bullish towards the market. But I think this concept is really hard because people oftentimes, like get afraid to like buy into a rally or sell into a low. And that's a tough, thought process for sure. But I think that's the right way if it's what you need for your portfolio. So just to like flip back so you guys can see where we're at. It's like our break-even points on our portfolio on the lower side are 235 on the S&P, and then on the top side all the way up at 255. So as long as the S&P trades between that range, which if I go back to the charts here, you guys can see what it looks like. So here's the chart of the S&P today, right? Trading a little bit lower at like 24 or 248 or so. So our break-even points are all the way up at sorry, the video just keeps reconnecting. 255 and then 235, which is down here. So really, this is our profit window, right? So yeah, we're getting a little bit bearish in tilt. Last week, the center of our portfolio was right about here, which is where the markets were. And so we need the markets to actually come down to make the most amount of money. So we need to add more bullish positions, which push up our break-even point on our call side. But still, this is a pretty wide range for us to make money. As long as the S&P right now, with all the positions that we have on, stays between that range, 255 and 235, we generate, some pretty good money. Like, this is why I think that this is so powerful, because, with options trading, I really don't care where the market goes as long as it goes in between that range, right? And I'll adjust along the way. So hopefully it's been helpful in just kind of understanding this concept. So let me know if you guys have any questions real quick before we jump off, or if you guys thought this is helpful, give me the thumbs up or the hearts. I don't know how to make a heart shape with my hand or whatever the case is. So, but we'll be jumping back in here this weekend on some other topics, which I think you guys will enjoy. So until next time, we'll talk to you guys soon, and happy trading.